The Century portfolio has a price to sales ratio of 0.75 times sales. So that, as you've just described, is on the lower end of this ratio.
Right. Well, the thing that we try to do, Scott, is, as you know, is we're just using the S&P as an example because it's the 500 largest companies and gives you an example of what's cheap and what's expensive. Okay? So when you look at the fact that 0.72 and 0.75 is near the bottoms, our portfolio price to sales right now is in that low zone. So that gives us a lot of confidence that we're holding value because that's about as cheap as it's been in the last only a couple of times in the last 20 years. So the S&P is quite a bit higher than that. So the only reason that it would go to as 1.52 times book or 0.74 to sales is if the earnings went down like they did in 2008 and 2009, and the interest rates got over 9% or 10% like they did in 1990. So based on the fundamentals of the earnings and of the valuation, there would be no reason why it would ever get that low. Matter of fact, I still maintain that the market probably wouldn't have gotten below 1,000 if we didn't have this next problem surface, which I'd like to use, and that's what we call mark-to-market accounting. I don't want to get too technical about it, but it's important to understand that principle because if the market shouldn't have gone as low as it did, and that problem is now solved, then it wouldn't go that low anyway. You see what I mean? Now, the fundamentals suggest that it shouldn't go back there, but this is even a more important thing. And basically, mark-to-market accounting is something that's surfaced at the bottom of the market. And let me give you an example of that. Let's say you've got a $100,000 mortgage, and you're paying 6%. So I've got an asset that is giving me $6,000. I've lent you $100,000. You're paying me $6,000 a year. And if I wanted to sell that loan to another bank, they would easily buy it if they were convinced the assets were there. Well, in mark-to-market accounting, if all of a sudden they started packaging these loans, so you've got some good loans with some bad loans, and now these packages are trading in the open market. And now all of a sudden there's a mortgage crisis and somebody wants to sell those assets. But when you go to bid on the assets, you have to buy the whole pool together, so you don't really know how many bad loans are in there and how many good loans are in there. So you're going to put your bid way underneath the market just to cover all those bad loans. Now, you're going to do that to cover yourself, but in the meantime, that value of those loans have gone way down. And if I've got them on my books, I don't only have to write them down on my assets, but I've got to take the loss from what maybe the thing is worth $100,000 one day and it's worth $50,000 the next, and I have to write those $50,000 down against my earnings. And that caused the earnings to go way down, it caused the assets to go way down, and caused a lot of banks to get into trouble. Now, how should you answer? Well, most of the time, if you have loans, you take them on an individual basis, and if people are making their payments, it's worth 100% on a dollar. If you have bad loans where people aren't paying, then you value the assets and you mark the price down. Mm-hmm. But in this mark-to-market accounting, at the time of the crises, there was no bids on these products because everybody was scared and they didn't want to take a chance on it. It's kind of like if you take your normal house in Austin and it's worth $250,000 to $300,000, and all of a sudden there's a recession and you want to sell your house real quickly, so you put up your house on the market, but you only have a week to sell it. And during that week, nobody gives you any bids. Under mark-to-market accounting, whatever you were offered as a bid, that's what that asset is worth. Never mind that it's worth $300,000 in normal time. You'd have to mark it down so some guy could come in with a low ball and say, look, this guy's got to sell it in a week. I'm going to give him $150,000. You sell it at that price. They appraise it and say, okay, we got a bid for $150,000. That's what it's worth. You got to take a $150,000 loss against your balance sheet. So obviously, for illiquid investment, that is a disaster, and that's what it turned out. I believe that's one of the main reasons that Lehman Brothers went bankrupt and Bear Stearns and all that. They had to mark their assets to the market. They were illiquid. assets that might have been worth 100% on the dollar might have been selling for 25 cents. You got to take the loss, and there goes your balance sheet. Now, let's look at the history of mark-to-market accounting, because I think it's when you take the historical perspective, it puts it into better view. Mark-to-market accounting existed during the Depression, and Milton Friedman wrote about that in his book, and he said that he felt that mark-to-market accounting was one of the main reasons that there were so many bank failures in '29. In other words, the banks weren't nearly as bad off if they would have been able to value their mortgages at the price they were selling for and the number of foreclosures they had. Because they had to mark them down, there were tremendous failures. So they finally got rid of mark-to-market accounting in 1938. And it's no coincidence that after 38, the economy and everything was picking up and gathering steam and doing much better. And from that period on, from 1938 till 2007, we never had the wide swings in the economy that we did before the Depression. Before the Depression, every recession was a bust and boom. And the reason was some of these rules. They eliminated that, so for many years, from 38 to 2007, we didn't have those wide swings in the market. And then in 2007, they issued another rule to mark-to-market accounting. They introduced it back in. It's called Rule 157. So right at the top of the market.
Yeah, back in November, right?
Back in November of 2007, they introduced mark-to-market accounting. And then as the crisis developed and they realized they couldn't continue to do this, 1 week before the market bottom, they made a statement that they were going to review mark-to-market accounting. It actually happened 3 days before the market bottomed that they made the statement that they were going to change it. And then I believe it was on March 12th of 2009, it became an official rule. So right in that period, the market bottomed. And I believe the market bottomed outside of the fact that it was dirt cheap, outside of the fact that the economy was heading down. The main reason it changed is people realized that if the banks don't have to use that mark-to-market accounting and they could work out their problems over the long run, just like we did through every other recession, then you wouldn't have that extreme, and the market has taken off for that. So when you summarize that question, why do I believe there's a low probability why the market get down there? It's first of all because of the job that the corporations did in rebuilding their balance sheets and getting margins up, building up their balance sheets. The valuation of the market itself, that was an extreme. It should have never happened. And more importantly, the elimination of mark-to-market accounting. Now, they have just suspended it. They haven't eliminated it altogether. So we are watching that very closely. If they were to reintroduce that, I think that you would increase the risk of this market, and we would react accordingly. But so far, it's been suspended. They're reviewing it, and the rule that they have in place now says that in liquidity crises, you use the normal process that they've used over the last 50, 60 years, that you look at the long-term value of this asset. So instead of pricing your home in the week you have to sell it in a bad market, they smooth it out and say, well, what would this be worth in a normal market? And that would be the appraisal. So I think when you sum up all of those reasons, we have reason to be optimistic that that is not going to happen.